The current market bias is very important to short-term trading in particular. By looking at the charts and economic numbers from the previous session, we can work out whether the currency's got a general bias, if it's going up or if it's going down. But the upcoming economic numbers themselves, this is where they come into play and can really impact the general bias of the market going forward. So with economic data releases, you're either going to get a positive bias if they're stronger than expected or a negative bias if they're weaker than expected. Market sentiment, this is where it overlaps with the central bank sentiment. Once the central bank has their meetings, that sentiment is in the market until the next meeting, or until they make a speech which changes the sentiment. So there's two different trading opportunities that you need to be aware of. If the economic data release comes out with the same direction as the sentiment from the central bank, well then there's potential for longer term trade. Secondly, if the economic data release bias is against the overall central bank sentiment, well there's still a trading opportunity, but it's probably a shorter term trade. The overall market sentiment will dominate the short-term economic bias which comes from the economic data. So you understand the difference between sentiment and bias. I have an example on the Aussie dollar chart to make sure this is clear. This is going back to when the RBA changed their sentiment from an easing bias to a neutral bias. The currency rallied quite aggressively from 87.50. The sentiment of the Aussie dollar was definitely up. During this process though, we had the unemployment figures come out a week later. When this data came out, it was a lot weaker than expected. There was a trading opportunity here, but it was a short-term one. We saw the currency fall quickly, and then once the unexpected data had been factored into the market, the overall market sentiment kicked in and dominated the market again. So the Aussie continued to rally regardless of that weak economic data release. So the overall market sentiment itself is much stronger than the short-term sentiment created from economic data releases. It dominates. This doesn't mean that currencies won't move up or down on the back of economic data, but as I said, if that move is against the overall sentiment, you only get a short-term move. If that data had have come out strong, we would have had a much bigger move to the top side and it would have been a better trade and a much longer-term one. When we're looking at the hierarchy of economic data releases, interest rates are the key release to monitor. Following that, we've got the Consumer Price Index, which is the core inflation number. And this is one of the most critical releases for interest rate decisions and is usually at the top of the central bank's watch list. The GDP number is the overall health check of the economies. This is a major release that you always need to be paying attention to. Then it comes back into the core numbers, retail sales, the unemployment rate and change, and then at the bottom of the list I have consumer confidence. But that could be interchanged with the number of releases specific to each separate economy.